Hi everyone. Thanks for tuning into my channel. This is All Things Accounting. The topic today is going to be accruals, particularly accruals for adjusting entries. So stay right there and we'll get through this together. So adjusting entries, in particular accruals or accrued expenses, accrued revenues, the reason why we have accruals are because of the time principle in accounting. We normally split the accounting period up into different specified periods of months, years. So normally a business would have a calendar, they would close the books at the end of each month. But because, let's say, for example, salaries, if they're paid on a bi-weekly basis, if it doesn't fall correctly within the end of the accounting month, then you have to, what we call, make an accrual for that, because you want to be able to account for the expenses that's relating to that particular accounting period. Okay, so that's under the matching principle as well. So we'll go through some numerical examples on the whiteboard. So if you want to come with me, we'll go through this. So adjusting for accruals. Let's say, for example, accrued revenue. Normally when we sell a good or render a service, we expect to get paid for it. Sometimes the payment or the receipt of cash might come later on, but we've already earned that revenue. So there might be some cutoffs with regards to the time principle and matching principle there when certain companies have, they go on a monthly basis there. So we'll run through some examples here. So let's say for an example for accrued service revenue. So for accrued service revenue, let's say that ABC company agrees to, they agree to provide consulting services. Consulting services for $2,700. And that would be covering the period from January 11th to February the 10th. So notice that is 30 days in total. But if this company, if ABC company closes their books at the end of January on a monthly basis, so at the end of February, so then we want to know what the revenue they can recognize on the books would be. So on January 31st, the entry that would be needed would be debit, accounts receivable, and credit, consulting revenue. And in this case, it would come out to $1,800. How did we arrive to such a figure? Well, we know that the total amount here was $2,700, and that's, if we calculate that over 20 days from January 11th to January 31st, that's 20 days over the 30 days there. That should give us the $1,800. Let's go through an example of an accrued salaries expense. So let's say that ABC company's only employee. ABC company has only one employee, and that employee earns $70 a day. They work from Monday to Friday only, and they get paid bi-weekly. So let's say, for argument's sake, that in January, the two periods that two bi-weekly period ends on January the 14th and the next one on the 28th. And that's on a Friday that it ends off. So if this is on a Friday, the 29th is a Saturday, the 30th is a Sunday, and therefore the 31st would fall on a Monday. But because this was earned in the period of January, even though it did not meet the cutoff of the bi-weekly, we want to accrue this so that it's belonging to January. Okay? So in this case, what we do is on January 31st, there's 1 day's salaries expense to accrue. Therefore, it would be debit salaries expense and credit salaries payable in the amount of that 1 day, $70. So our last example will involve accrued interest expense. Okay, so in this case, let's say that it's common for, so in this case, it's common for notes payable or accounts payable to be charged interest. People don't allow you to just take your time to pay. There's always going to be some type of extra incentive for allowing them to do that, and that's called interest. So let's say if on January 1st, a company, it doesn't matter who, let's say ABC company, has a $6,000 notes payable at 7% annual interest. Then let's say on January 31st, what would be the amount that we have to recognize that has elapsed? So it would be debit interest expense, credit interest payable. So that would come out to $35 in this case. How did we come out to that? It was $6,000 multiplied by the 7%, so 0.07, divided by, and that was the annual rate, divided by 12. So that comes out to $35 there. Then when we pay it off, later on when we pay it off, it would be debit interest payable, because then we paid it off, so we're reducing the liability amount, and credit cash, whatever we're using to pay it off with. So I hope that these three examples help you understand a bit more about the nature of accruals, and I hope that you found it to be very useful. So if you enjoyed this tutorial, please subscribe to my channel, hit that like button, and please remember to hit that bell notification icon so that you're always up to date on the new tutorials that I'll be posting in the future. So until the next time, take care.